Picture this. You're a DC resident, you're over 50, and it suddenly hits you that your long-term care insurance is now part of the divorce conversation. It's not just some policy sitting in a drawer anymore. Maybe the two of you bought it together 15 years ago with a shared care rider. Or maybe one of you is a federal employee with FLTCIP coverage and the other is not. Either way, you are asking the exact same question right now. What happens to this policy now?
This explainer covers exactly how DC divides long-term care insurance in a gray divorce and what each spouse needs to do to protect their future care coverage.
To get there, we're going to break down 6 specific realities. We'll look at the marital property reality, shared riders and discounts, federal FLTCIP coverage rules, how to value the insurance policy, Medicaid and the financial stakes, and finally, protecting your coverage. Let's start with number 1, the marital property reality, specifically under DC Code Section 16-910. A question I hear across my desk all the time is this: is my long-term care insurance going to be divided in my divorce, even if it's only in my name? The law here is actually very clear. Under DC Code Section 16-910, long-term care insurance bought during the marriage with marital funds counts as marital property. This means it gets divided fairly between spouses, regardless of whose name is physically on the policy. The fact that you used marital funds to pay those premiums creates a very real marital interest in that asset.
Moving to Section 2, shared riders and discounts, and how we go about untangling joint policies.
Here's the next big question we get. We have a shared care rider that pools our benefit years. What happens to that when we split? A shared care rider, that feature that lets 2 spouses pool their long-term care benefit years, has to be removed or converted after a divorce. Once that happens, your benefits simply revert to individual periods. So, if you started with 4 years each, you go back to having 4 years each. But here's the upside. Because you're no longer paying for that shared benefit pool, each spouse's individual premium typically drops by 10 to 15%. Now, naturally, that leads to this financial concern. Will I lose my spousal discount on my premium once the divorce is final? You can breathe a sigh of relief here. Most major carriers actually maintain the 10 to 30% spousal discount even after a divorce is finalized. Because each spouse actually holds their own individual policy, the discount usually stays locked in. So no, you don't automatically face a massive premium hike just because your marital status changes. Let's turn to Section 3. Federal FLTCIP coverage rules under 5 CFR Part 875. This is absolutely critical for our area. People frequently ask, I'm a federal employee or married to one. Do I keep FLTCIP coverage after the divorce? And can either of us get new FLTCIP coverage right now? Federal employees and their former spouses do keep their existing FLTCIP coverage after divorce under 5 CFR Part 875. It stays at the exact same premium rate as long as premiums keep getting paid. But here is the critical catch. New FLTCIP enrollment has been suspended since December 19, 2024, for at least 24 months. That means a spouse who doesn't already have it cannot simply sign up after the divorce. This brings us to Section 4, valuing the insurance policy and calculating equitable division.
These policies present a unique, complex math problem because they almost never have a cash surrender value. To help you navigate this, the article breaks down exactly how DC courts value a policy that has no cash surrender value, using either the premium investment method or the replacement cost method, and it's linked in the first comment below.
Now for Section 5, Medicaid and the financial stakes. We need to talk about the real cost of losing coverage. $549. That is what a private nursing home room in Washington, D.C. runs per day. That comes out to close to $200,000 a year. This harsh financial reality places D.C. among the 3 most expensive jurisdictions in the entire country for this kind of care. Which leads us to a very serious question. If I end up without adequate coverage, how does losing my spouse's income and Medicaid protections change my situation? Losing the marriage also means losing DC's Community Spouse Resource Allowance. When you're married, that allowance protects up to $162,660 for a non-applicant spouse. But after divorce, a single applicant's Medicaid asset limit drops to a strict $4,000. That drop happens the day the divorce is final, and it's a very real factor for whichever spouse ends up without solid long-term care coverage. Finally, Section 6, protecting your coverage and navigating these deadlines.
The last piece of the puzzle is practical. What do I actually need to do, and by when, to protect my coverage during the divorce process?
If you want the full 5-step checklist for protecting your coverage during the divorce, along with the separate process for converting a joint policy to individual coverage, the full article is in the first comment. Long-term care insurance in a DC gray divorce isn't a side issue. It's marital property with real deadlines attached. From shared care riders to FLTCIP enrollment windows to Medicaid asset limits that change the day the divorce is final. If you want DC family law guidance like this without having to search for it every time, I invite you to subscribe. Ultimately, as you look at your own policies tonight, you have to ask yourself, if the unexpected happens tomorrow, is your financial independence actually protected by the law or just by the assumption that things will work themselves out?